half an hour away from the opens in Hong Kong, Shenzhen, and Shanghai. You're watching The China Show. I'm Yvonne Man with Stephen Ingles.
Our top stories today, China-U.S. trade talks to continue in London with hints of progress on sticking points around tech curbs and rare earth minerals. President Trump says the going is not easy.
The trade optimism helping Asian stocks move higher. Tech in focus as Apple's developer conference leaves AI-hungry investors wanting more.
And again, President Trump deploying 700 Marines to Los Angeles in a move slammed by the state governor as dictatorial.
All right, it is still about the trade headlines here that are moving these markets this morning in terms of how risk assets are concerned. We continue to see equities here in the region doing quite well, right? We're punching higher by a third of 1%. U.S. futures are also in the green here this morning. So the fact that the U.S. and China are entering a second day of talks in London, that certainly is helping sentiment here across the region. Dollar is unchanged here at the moment. We're watching very closely what this means for, of course, the rare earth side of things and also tech, right? Because it seems like what came out of London and Buckingham Palace was that the U.S. was willing to ease some of those technological curbs in response for China easing curbs on rare earth. So that certainly is the key focus for the market here this morning. We're watching Taiwan come online and see how even the tech space, even the Apple suppliers are doing, as we mentioned in that developers conference, a lack of concrete details when it came to how AI was going to be integrated as well. So certainly maybe some disappointment there, but right now Taiwan doing quite well. We're up about 0.9%. Also when it comes to yields, right? We're getting closer to that U.S. CPI print in the U.S., which could be the next sort of driver in terms of bonds. But then again, we're entering to a blackout period for the Fed pretty soon as we get closer to that Fed meeting. So right now, yields are ticking slightly higher in Asia. The Australia 10-year yield, meanwhile, is up some 2 basis points as well. Gold is on offer here this morning, and we are seeing a bit more strength coming through to dollar Japan. But you take a look at when it comes to iron ore and copper, that continued divergence that we're seeing in those commodities is quite telling too as well. What does it tell us about demand at the moment, despite what we saw with those export figures in China yesterday, where basically shipments to the U.S. was at the lowest we've seen since the pandemic. What we are seeing, though, are signs of green and optimism in China, right? So maybe this whole sort of diversification around the U.S., China has become a beneficiary of that. You take a look at how the HSCEI, we entered into a bull market yesterday here, really propelled by the likes of, look, there's more optimism around trade. We had this reemergence of AI plays once again. And interestingly enough, it was healthcare that helped lead that drive higher when it comes to this index and really getting into that bull market territory. We talk about all the innovation around biotech, on oncology. That's certainly something that we need to watch in the next coming months or so. And the likes of Morgan Stanley saying there is still legs here in this rally, given just how positioning is still quite low and underweight from some of these foreign investors at the moment. Flip the boards. We're watching how the open is faring here today. We were watching also very closely what happens in the short end of the CGB curve. So there's news that yields are heading lower. We don't know why. Is that a sign that the PBOC is stepping in? Because state banks have really been stepping in and buying a lot of these these bonds on the short end as of yesterday and recently here. So maybe after a 5-month hiatus, is the central bank coming in and buying? And is it a prelude to the central bank actually buying bonds to help at least aid the economy? So certainly that's one thing to watch. Futures are looking like this here at this moment. So we talk about the trade talk, we talk about AI, we talk about healthcare. We'll see what else is there in store. But yes, futures are pointing higher this morning, Steve.
All right, Yvonne, let's set the table for the rest of the day and what we're going to be covering here on the China Show, what's happening in Greater China. And I think, of course, what Yvonne just talked about with that H-share index, the HSCEI bull market, now up 20% year to date, reflective, of course, of some of the optimism towards what's happening in London. It's day 2 coming up on Tuesday in London time after 6 hours of talks between He Lifeng leading the Chinese delegation and also Scott Bessent, Howard Lutnick and Jameson Greer leading the U.S. delegation. They talked for 6 hours at Lancaster House near Buckingham Palace. Didn't get a big readout, though, Yvonne, from the Chinese side. Actually, He Lifeng ran right past the gaggle of reporters. Bessent said it was a good meeting. Lutnick said it was fruitful. So that's really going to dominate it. And, of course, some of these other issues, rare earth stocks have been on a tear a bit because of the optimism that there could be some easing of those curbs and the licensing from China if if there is goodwill showed on both sides of the table in London. Solar stocks, the solar conference in Shanghai, really reflective of what's happening in that really damaged market where there's hyper competition. Yvonne?
Yeah, and you talk about the trade talks, right? So we're getting a little bit of news, not really quite full readouts, as you say. Yeah. But it does show that the first time that we're hearing the U.S. at least willing to loosen some of these chip curbs or technological curbs.
Sure. We're hearing from sources that perhaps some of those export controls that came in after the mood turned sour in Geneva, right? And both sides were kind of accusing each other of not acting in good faith of that agreement that they had in Geneva and that truce. So maybe they can take off some of those export controls on Chinese on the high-tech side, but not, according to Kevin Hastert, essentially those AI advanced NVIDIA chips, which invoke national security concerns and, of course, the competitive fight between
Not
China
the high-end
and
stuff.
Not the high-end stuff.
But it's interesting, right? We heard from the Huawei chairman who spoke in a Q&A. Yeah. And this has been kind of the top sort of story in the People's Daily.
It was the front page of
basically
the People's Daily.
Saying that, you know, we don't need, it doesn't matter what these export curbs do in the U.S., Huawei can still thrive in this environment. And it makes me wonder what, you know, NVIDIA Jensen Huang had said maybe a few weeks ago at Computex, saying that if the U.S. doesn't loosen these curbs, you know, rivals like Huawei are going to fill the gap. Yeah,
that's right. And I think the fact that the Chinese are not saying anything right now, they're holding their cards very close to their chest. I think there's a lot of skepticism of the U.S. intent in these talks and whether they're going to be showing goodwill. It is very good sign that they're going into day two. He Lifeng has an itinerary until Friday in London, so perhaps that is showing some optimism, but he can cut that short anytime he wants.
Yep, and we heard from the president of the U.S. as well, President Trump, talking about those talks. Let's take a listen.
We are doing well with China. China's not easy. We want to open up China, and if we don't open up China, maybe we won't do anything, but we want to open up China. It'll be a great thing for China, a great thing for the rest of the world.
Let's bring in Alexander Davey, head of client portfolio managers at Eastspring Investments here in town. Alexander, always great to have you. It seems like right now everything is dominating is trade, but how do I kind of filter the noise right now?
I think we're trying to look a little bit through, as we have to a degree for the last 6 to 8 months, a lot of uncertainty, volatility from an asset management perspective, getting back down to the companies. Because ideally, we'll talk about the index level, but be it the S&P 500, CSI 300, whatever, is representative of a lot of different industries, a lot of different sectors. And you've really touched on it just in the last couple of minutes there. You know, the impact for chip manufacturers could vary very much depending on the type of chips that they are manufacturing, software, healthcare. So for us, I think it's about trying to start to see what is actually going to be building through these supply chains, how the impacts of tariffs, the pauses actually come through. And then when we think about some of this inflation data, as it probably starts to tick through, we started to see those receipts coming up for the US Treasury in May. I think we probably start to see a little bit more of an inflation impact into June. But it is the extent to which companies have managed their inventory over the last 3 to 6 months as to whether we start to see spikier inflation or whether actually it's more moderate.
Well, what's your take into the second half? Because coming into the first half, there was a lot of uncertainty with the Trump administration, a lot of volatility. I assume those are going to continue. And then where do the fund flows go? Out of U.S. or S&P 500 still doing pretty well?
Very, very interesting dichotomy for investors, because we know that uncertainty, volatility is going to continue just because of the nature of everything that's going on geopolitically as well as trade talks. At the same time, there's a couple of quite interesting data points. One is if you actually start to look at searches by large blocks of real money assets, the areas where they are most concentrating efforts, and we're seeing net outflows now, particularly from some of those big schemes beyond, outside of Asia, are global and US. And remember, global equities is still 60% US equities in there. So that could be where we start to see a little bit of this decrease of exposure to Asia, to the US. It feels like there is an overexposure. I think the other element with that is if you buy the US at the moment, you can argue that a lot of the stocks in the US are growthy stocks. They're already pricing in a lot of the next year's future earnings. So what is it you're buying? You're buying hope that continues further. So there's a good case that valuations favour that diversification play away from the US. I think maybe we're starting to see some real money start to move in that direction as well.
Where are they going, real money?
We're seeing the conference that I was attending recently came out with a couple of interesting things. There's certainly interest in markets such as India. There's interest in China, but I think that that's tempered by maybe some investors thinking about that broadly as Asia or emerging markets, others being more granular. Yeah. But again, a lot of the mood music is around being active within those areas. I think there's concern that the beta returns, they can be very different depending which China index you pick. They're very different across markets.
Because if you go beyond the Mag 7, what's comparable, right? The Mag 7 has delivered very well in the United States. So there isn't those kind of CapEx opportunities, or are there outside?
I think we go through periods where we get, I hesitate to say distorted, but you get markets driven by very, very specific behaviour. And we've seen that over the last 10 years. You could argue whether that's because of QE or other things, where small blocks of stocks really drive quite outsized market returns. We don't have to cast our minds back too far. For those of us who are greyer in the room, maybe a little bit further. But if we start looking back, this was about equity risk premia that were 3 to 5%, bond yields at 4%, so all-in returns around about that 8 to 10% level. And that was what people were putting in their models. We've got used to these, high teens returns. Maybe we're just getting a bit of a reversion, a return to the fact that you pick good valued markets, you find interesting stocks. If your beta's not giving you outsized returns, then it's about thinking active, thinking in the markets like Asia, like emerging markets, that maybe it can offer some of those bigger stock returns. But it is going to be about finding those rather than just harnessing yourself to an index level. And that's possibly the challenge. And Mag 7 has exacerbated that because they've been the biggest stocks in the index and they've been driving the index. So it's felt like that's where we should all be.
Beyond just equities, how are you looking at the dollar? How are you looking at treasuries at the moment? So there's certainly a lot of debate about whether it is a safe haven anymore.
I think we're looking at treasuries, certainly for our fixed income team. They're looking slightly on the shorter end of the treasury curve, but they're interested when they start to see the opportunity to buy on dips. But they're being quite cautious. I think a mix of what's happening with trade, what's happening with the dollar, and what's happening more broadly with the Fed. So I think we want to see a little bit more stability of view to be able to see that. I think for the dollar, we continue. Absent a US consumer that continues to spend and spend and spend and spend, that really would support the economy in a way that doesn't look likely at the moment, the dollar's likely continue to weaken, I think, into the second half of the year. We've probably seen the dollar strengthen about 20% over 5 years. We've weakened about 8 to 10, so there is certainly a little way that you could go just to get back to prior 2019 to 2020 levels.
What's your view on the other side of this trade war, and that is China? Obviously, Hong Kong and the 8-share index reaching a bull market of 20% year to date. There is some optimism built in there, but we're coming off pretty low numbers on Hong Kong. It's been a depressed market. But China, Hong Kong, what's your view?
China, I think we were quietly confident coming into this year. We felt that there was definitely some areas for optimism. I think it goes back to the fact that that's really within certain specific areas and specific sectors. And I think that some of those consumption plays, some of the technology plays certainly look quite interesting. I think that we continue to see that. I also think that there's a very intriguing balance between markets like China and India with very, very low correlation, being very interesting for those putting together portfolios, because potentially you can actually get the double effect of an India market that is less exposed to the US, lower inflation, cutting rates, alongside a China market where we still have the very big question mark about what does the Chinese government do if they need to add stimulus. But that could really buoy the market and all the companies in the second half as we see these trade talks and we see the macroeconomy develop.
Alexander, thanks so much for joining us here in the studio this morning on Tuesday. Alexander Davey, Head of Client Portfolio Managers at Eastspring Investments. Still ahead on the China Show, we get a frontline view of the trade war with the CEO of global contract manufacturer Komaspec. Please. Plus, we talk about market strategy with the Bank of America, Morningstar Asia, and BNP Paribas Wealth Management. A whole lineup of guests this morning. And we're counting down to the open of trade in Shanghai, Shenzhen, and Hong Kong. This, of course, is the China Show on Bloomberg.
All right, your MFIX just crossing the Bloomberg here this morning, and we are seeing at a 718.40 level here. So that's pretty much close to estimates here, just slightly on the stronger side. But then again, it's pretty much steady as she goes. But we are still seeing a little bit of strength coming through for the currency this morning, Steve.
All right, big story obviously happening across the Pacific in Los Angeles. The Trump administration has escalated its response to anti-deportation protests in Los Angeles by deploying 700 active duty Marines. California Governor Gavin Newsom also posted on X that the president is sending another 2,000 National Guard troops. Bloomberg's John Herskovitz has been following developments for us. He joins us now. So, John, tell us, what will the Marines be doing? Marines are used to carrying lethal weaponry, if you will. This is an unprecedented move, isn't it?
Yeah, it's a very unusual move to begin with. The Trump administration said that the 700 Marines are going to seamlessly integrate with the 2,000 or so National Guard troops who are deployed there. The justification is that they are there to protect federal property and the federal troops and the National Guard troops, who they say are increasingly coming under threat. Now, as you mentioned previously, California's against this. Governor Gavin Newsom is leading a charge for the state, which is suing to prevent this. They say that this is unjustified, unlawful, and it's just a way of increasing provocations to make things worse and not better. So it's really unusual for this to happen. And we're having very different views of what this deployment means.
Yeah, maybe talk us through some of the worries around this deployment, John, and really what should we be watching out for next?
Yeah, I think the worries are the use of troops, whether it's National Guard or this very rare use of national military, Marines, Army, Navy, in a situation, domestic situation. The use of the National Guard without the consent of a governor hasn't really happened in about 60 years. This was during the civil rights days, civil rights protests in the U.S., when I think Lyndon Johnson was the last president to do this. The use of active military personnel for policing is, for the most part, unlawful. There are a couple of 19th century laws that have provisions which could allow this to happen, but it's not something which goes forward in the United States. It raises worries about a police state, the use of troops to suppress people. But there have been a few exceptions. During the 1992 Rodney King riots in LA, U.S. troops were deployed, but this was at the request of the mayor and also of the governor. So it can happen if there's a need for it, but going above state officials is just very unusual.
John, thank you for that update. John Herskovitz there joining us out of Tokyo. Some other stories that we're following for you today. The leader of Japan's largest opposition party, Yoshihiko Noda, says the country should use the expansion of the Trans-Pacific Partnership as leverage in trade talks with the U.S. His comments came after Japan's chief negotiator returned from a fifth round of talks in Washington with no reprieve from tariffs. There has been little progress in talks despite phone calls between Prime Minister Shigeru Ishiba and Trump. The UN nuclear watchdog says Iran's stockpile in enriched uranium cannot be ignored and urged nations not to turn a blind eye. The warning comes as the IAEA's Board of Governors meet this week in Vienna. The agency reported last month that Iran's inventory of close to weapons-grade uranium is at record levels, growing by 50% in the last 3 months. Ukraine says Russia has attacked with drones and missiles early Tuesday morning in Kyiv. This coming after the two sides started a major prisoner exchange. The first groups of prisoners under the age of 25 were transferred. The planned swap of 1,200 people from each side is set to be the largest to date since the invasion of Ukraine. All right, we're taking a look at the pre-market in Hang Seng. It looks like this market continues to extend those gains here. The Hang Seng is up 1/5%. We're back to those levels that we saw in March for that index here. Keep in mind, 8 shares also in that bull market territory. Yields are pretty much flat in the 10-year at 169, and strength in the currency as, of course, day two of talks between the U.S. and China happen later today. Plenty more ahead. This is Bloomberg.
And welcome back to the China Show. Here are some of the big corporate stories we are following this morning. Bloomberg has learned that Barclays is preparing to cut over 200 investment banking jobs. Sources say staff in global markets and research may be impacted, with managing directors the most senior roles affected. The move is meant to give the bank more capacity to invest in priority areas such as European rates, equity derivatives, and securitized product trading. Disney says it must pay Comcast almost $440 million more to complete its purchase of the Hulu streaming service. The transaction will reduce Disney's net income in the fiscal third quarter. Disney has already paid nearly $9 billion for Comcast's one-third stake in the business, valuing Hulu at around $27 billion. But Comcast has argued that the business is worth much more. And Warner Brothers Discovery shares gave up a 13% opening gain to close 3% lower after announcing a split of its fast-growing streaming business from its legacy media channels. The move unwinds much of the 2022 merger that combined Warner Media and Discovery. The streaming and studios business will be led by CEO David Zaslav and will hold a 20% stake in the new global networks business.
All right, we're taking a look at when it comes to how futures are setting up here this morning. And when it comes to U.S. futures, they're still punching higher this morning. In fact, it's above that 6,000 level, which really has sort of been a ceiling here for this equity market, despite we're bouncing off those 20% in the last few weeks or so. We still haven't reached that record high that was reached back in February, but certainly looking pretty good right now. Asia is also doing quite well. And we talked about China. The 8 shares basically are the gains that we've seen are double what we saw for the most of the region here already. Hang Seng pre-market is looking like this. HS Tech is catching a bid, and there you go, more gains for HSCEI here. We're getting very close to that 8,800 sort of level, and 717 for the currency this morning. In terms of stocks to watch, it's very trade dominant here. You take a look at how these rare earth stocks, they've been doing very well. There you go. Here's another day of solid and punching gains here. China rare earth up some 15% already. So they are trying to at least ease those tensions over rare earths, over tech. So chip stocks also in favor today too, Steve.
You know, China has a lot of leverage in these talks. They own about 70% of the production of rare earths and 90% of rare earth magnets. So they're feeling some power going into these talks and leverage. Yeah, and you take a look at how some of the tech plays are doing here this morning. This was on the back of what we heard from the Huawei founder, Ren Zhengfei, as well. China should not be too concerned about these U.S. export curbs on advanced chip technology. We got the open coming up next. Welcome back. We're kind of down to the opens here in markets, and welcome back to the China Show overall. So yes, so we're seeing a second day of trade talks in London between the U.S. and China. That certainly is helping this equity market once again here in Hong Kong. Pre-market is up about 1/5 of 1%. Not as big as what we saw yesterday in the H-share market, but certainly we entered that bull market territory already. So all signs point to, I guess, hope that things are going to be better. There are these easing tensions between tech curbs, between rare earth curbs, Steve, and so certainly that is helping overall sentiment once again here today. Yeah, absolutely. Tech and rare earths in focus. They've been for a while, and they will continue to be in focus as we have those talks. No real results yet coming from those talks in London. 6 hours on day one. More talks coming later Tuesday, obviously. Yeah, so fruitful. It was a good meeting. That was one of the commentary we got from the U.S. side of things here. We didn't hear from the China side, but certainly it seems like things are looking pretty good in these risk assets here today. So certainly that's one thing to watch, and whether we continue to see more gains for this market. There you go. We're flat on the onshore market here right now. We're watching that the currency real quickly here as well. It was the second day in a row that the PBOC said that fixing below what traders were estimating. So maybe it signs that they're willing to allow for more strength in the currency. It maybe has good faith in these trade negotiations here. So maybe more signs that dollar China can nudge a bit lower here as well. Iron ore is on offer in Dalian. Shanghai crude, though, doing quite well. We're up about 1.5%. And copper and iron, that divergence continues to go in opposite directions. We got Bank of America's Matty Zhao joining us a little bit later on to maybe help us decipher what that means. CATL shares in the A-share market is up slightly here, but not really huge gains that we're seeing against some of these consumer stocks in particular. Medea Group's up about 31%. Let's flip the boards and show
show you how Hong Kong is doing, because that's really where a lot of the action, the southbound flows, are heading up, heading to here as well. Looks like 8 shares are coming off right now. We're just slightly lower there, but we're holding on to the gains that we saw yesterday. But there you go. The likes of, I think, UOB, it was Morgan Stanley that came out saying, look, there is still ways for to really this rally to continue, right? They talk about the low positioning. There are still foreign investors that are still quite underweight at this market, and that 8 shares may still be that beneficiary as well in that destination. HS Tech catching a slight bid. It's pretty slow going though, but you are seeing some decent gains coming out of Alibaba. We're up about 0.75%. Baidu as well, and we're focusing on those Apple suppliers, right? So we'll watch AEC Tech, Sunny Optical, because it was really the lack of sort of big news when it came to AI and that developers conference, where we are seeing some of these Apple suppliers potentially are disappointed as well. You flip the boards, we're watching all things rare earth stocks, China stocks as well, solar stocks, I should say. Rare earths are still doing very well. So this is really very sentiment driven here right now. But yes, another day of really punchy gains there as well. Solar stocks, there's a conference happening in Shanghai, and it seems like things are, well, doing okay. So maybe some news there on that front when it comes to solar. You have JA Solar, for example, up close to 2% here as well. Steve.
Yeah, it's relative, though. That industry has been absolutely hammered by intense competition domestically and, of course, a slowing domestic economy and dwindling export markets. Okay, well, now for more on the U.S.-China trade talks, of course, they're heading into a second straight day in London. We're being told that the Trump team may be willing to ease some restrictions on tech and industrial shipments to China in return for access to rare earth minerals. President Trump says discussions are going well, but China is not easy, quote unquote. Let's get the view from a firm perhaps caught somewhat in the middle of the trade war. Komaspec is a Canadian contract manufacturer focused on industrial goods with facilities in China, Vietnam, and Mexico. CEO and founder Maxime Berube joins us now. Thanks so much, Maxime, for joining us. Give us your assessment on how much is at stake with these talks and repairing of the relationship between China and the United States. What contingencies do you have to have as a primary player in China that has a supply chain that you call quite amazing and very difficult to replace?
Well, hi, Stephen. Hi, Yvonne. Thanks for having me. Well, for sure, in time of uncertainty, I mean, people around the world, they are going to look to diversify. So, for sure, China is going to be a country where manufacturing is fantastic, agile, very competitive, and it's going to be hard to replace. So I will believe that most companies, in the US will look to diversify, and they will look at the China plus one. For sure, the capabilities of China has developed over the last few decades is very special, is very unique in its sense, and I think it will be very hard to replace this capacity.
Can you tell us just how the last 90 days, or we're in the middle of this window of the trade truce here right now, what is activity like amongst supply chains and the manufacturers that you deal with right now? Are things actually pretty active as they take advantage of this window, or are people still wait and see?
I will think, depend of industry. Some industry, there is a wait and see approach. Other industry, they are very active. So they are actively looking to diversify the supply chain. I will say Mexico and Vietnam are probably going to be the biggest winner in this, depending on what happened with the trade tariff agreement that will be done in the US. But for sure, some industry are more impacted than others. One thing we should not forget is that a lot of companies, a lot of American companies, they're selling worldwide. Therefore, I will believe they will use their China manufacturer to supply around the world, and they will look for other options for the U.S. market.
How difficult is it for you to diversify away from that amazing supply chain, especially at a time as well? There's been persistent, for more than 2.5 years, persistent factory gate deflation. Things to produce are a bit cheaper in China, but also up against those geopolitical and trade tensions. What are your plans to diversify? You're in Vietnam and elsewhere.
Yeah, in our case, we opened Mexico a few months ago, and we're starting production in Vietnam in a couple of weeks. So for sure, not everything can be made in Mexico, and not everything can be made in Vietnam, due especially to the supply chain capabilities China have, but also the amount of knowledge there is in the supply chain, but also on the factory floor in China, and the engineering knowledge that's been built over those decades is going to be hard to replace, because when you build complex product, it requires a lot of knowledge. It requires, facilities, equipment, and a huge amount of know-how.
And what are the implications, right? If we continue to see no progress, no consensus on a trade negotiations with the U.S. and China, I mean, are your customers, are they looking at raising prices? I mean, are they able to pass on those kind of pressures to consumers, for example?
Well, there will be inflation. So there's a certainty. If those tariffs remain in place, there will be inflation, because if the manufacturer in China cannot take the price difference, and most of the company in US cannot take the price difference either. So the consumer will end up paying those tariffs. After this, yes, people are going to look at manufacturing in other countries, but for sure, if you consider the tariff in China now that are extreme, I will say, other countries tend to be a little bit less competitive than China. So depending on what kind of tariff there will be at the end of the trade war on those other countries, we will see what will happen.
Maxime, what happens in the worst case scenario? Tariffs go back up to 145%, talks fall apart, and there is a Cold War economically and trade between China and the United States. Is it feasible? You know the contract manufacturing business. Is it feasible to move a lot of that to North America, whether it's your home base in Canada or in particular the United States?
If all those happen, the demand will reduce, so the consumption of the end user will reduce. But after that, there is a manufacturing capacity that's available worldwide. If you compare USA, there is not so many unemployed people who want to work in manufacturing. So I will believe some industry will be able to nearshore in the US, but a small amount, okay? Because a big share of the population in China is working in manufacturing, and this capacity won't be replaced with few 100,000 people in America for sure. So the product, as long as demand remains, the product will be manufactured somewhere.
It looks like you also may be interested in investing, as you say, your home base, Canada, a few years down the road. Can you tell us a little bit more about the rationale and what could actually swing you to make that decision?
Well, for sure, there is a lot of things that are going on in artificial intelligence, in digital manufacturing, and I will guess, in a couple years, there will be, hardware AI. So currently, as the manufacturing, the manufacturing picture is in worldwide, there is some task that, no matter if you robotize, you automate, and you invest a lot in AI, you still need people to manufacture those. At some point, I will believe that, when there will be robotic AI to manufacture, not only robot, but robot who can perform tasks that only human can do now. I will believe that, the manufacturing landscape might move a little bit, and at that point it will all depend on what capabilities each country has developed in terms of technology, what manufacturing equipment and what's the manufacturing infrastructure available, and also all the knowledge and the engineering capacity they have in different companies.
Maxime, we're going to leave it there. Maxime Berube there, CEO and founder of Komaspec, joining us. Coming up, BofA Global Research joins us next to talk commodities and the market outlook in China. They also have a new report talking about the CapEx AI value supply chain, so non-IT sort of things.
charges AI?
We'll talk about it with Matty Zhao coming up. This is Bloomberg. All right, we're going to talk commodities here right now. We've been tracking this sort of divergence between copper prices and iron ore. It seems to be going in basically, opposite directions here right now, where copper continues to see a lot of interest and prices are higher. Obviously, there's a lot of concerns around the demand picture with copper as well. But yeah, iron ore is basically continue to head lower. So what's causing this, Steve? It certainly is a big question that we're asking.
Property and electric cars.
Maybe,
and
yeah.
That's very layman's view of it. And the demand for electronics in copper, iron ore obviously goes into skyscrapers. Chinese economy is in persistent deflation for 2.5 years. Property market is moribund.
Yeah, and obviously with the tariff, we saw with the trade data yesterday, it didn't really quite help those exports in May, right? And it really goes to show, well, what does this mean in terms of demand right now? Joining us is Matty Zhao, head of APAC Basic Materials, Oil and Gas Research of BofA Global Research. He's also the co-head of China Equity Research. This is kind of aligning with the views that you guys have been highlighting, that copper prices can continue to head higher. Why do you think there is that divergence?
Yeah, sure. So let's look at demand, right? So copper demand is mainly driven by the power grids and also the EV cars. Year to date, China's apparent demand on the copper is actually on high single digit. We haven't seen that for a long time. Grid investment is up about 15% year to date because of a lot of the AI data and a lot of the power demands and renewables needs as well. And at the same time, EV sales was very strong at nearly 40% growth. So these are the key drivers for copper demand. At the same time, we're having a lot of the copper disruption. One of the biggest, the copper mines was on suspended recently as well. While on the iron ore side, iron ore obviously more driven by steel and still driven by the infrastructure and property markets, which we are seeing continuing decline. And iron ore has been one of our most bearish commodities. And also we are having a large iron ore projects coming by the end of this year, which will probably lead to some concern on the supply side.
So a lot of supply and the demand is an issue. Obviously, the trade war is having a number of different issues with Chinese demand as well. A lot of companies are cautious on capex. They're also waiting for any kind of positive stimulus measures from the government. The government's sort of taking a step back approach because if the talks go well, tariffs stay low, you don't have to ramp up stimulus, right? So how do you see the indirect and unintended consequences of the trade war impact on these commodities?
Yeah, sure. So in terms of the trade war, you can see that actually, just like what you said, Steve, a lot of the companies and industry are actually holding back for the unnecessary capex. But of course, some of the areas are very urgent needs in the capex, like the grids I've been talking about. And of course, the EV is the area that government have been pushing as well, the subsidy, etc. And the home appliance going out for exports have been quite strong year to date as well. All these are benefiting on copper front. While on the other hand, we have been seeing, the property continue to decline year to date on a double-digit level. And also a lot of the unnecessary, or maybe you can say that can wait projects on infrastructures are also holding back on waiting as well.
You mentioned the demand picture in China. What is sort of the pain threshold then? I mean, can the industrial sector kind of keep producing when you have copper prices getting very close to 10,000 now?
Well, depending on whether you can pass on the prices as well. So some of the areas, so for example, transformer sectors, because of very strong need of exports, right? So transformers export were up 40% year to date. So they can probably passing on some of the copper prices. And the grid, of course, copper is a very small part of the grid cost, and it's a strong needs to meet the renewable demand to match as well. So those ones were still investing.
Matty, give us the key takeaway of this new report, the AI charges up. We're talking copper, as we've just been talking about that, so maybe we can move on to the other areas. Humanoid robots, autonomous driving, resources, grid, electricity, smart manufacturing.
Yes.
What's the key takeaway we need to know?
Yeah, of course. So we believe that the China AI capex, related capex, to be around 600 to 700 billion RMB this year, which is driven by the government policy and also the internet firm, and the telecom companies as well. And from the power side, we are expecting an 18% CAGR growth until 2030 for equipment and also the power generation. At the same time, humanoid robot, we are expecting it to grow to 1 million units by 2030s. And that's because of the cost reduction. We are expecting costs probably can reduce to half if all these products to be made in China by 2030 versus now. At the same time, we are also expecting some of the autonomous driving, for example, LiDAR market to grow at 50% CAGR, and also the eVTOL to grow at 60% CAGR as well.
Well, humanoid robots are fun to talk about, and Elon Musk talks about Optimus and the introduction there in the United States. But in China, how much does that improve the whole smart manufacturing equation? Humanoid robots replacing manpower.
Yeah, sure. So now at this moment, I think humanoid robot is still a very small proportion. So last year, we only have about 2,500 units. So it's as a start. And currently, most of the humanoid robots are still in the industrial sides. We do believe with the cost going down, we do believe this will gradually expand it to the services level, like, for example, the deliveries. And then probably by 2030, more to the household as well. So we are expecting 10 million units by 2035 with the household coming in.
So how do I invest in that sort of environment there?
Yes.
If it's non-IT and energy-related sort of portfolio around this theme. How to invest
so I think our report look at the non-IT capex and energy capex. So obviously the upstream that the one to benefit is on copper, on commodities, probably also rare earth, and also the aluminum helps as well. And then into the power, we like the grid related and also the transformer producers that can help both overseas and also within China as well. And of course, within the data center, you need the cooling. Cooling, we are expecting the liquid cooling to grow at over 50% CAGR as well. So some cooling companies should benefit on those. And downstream, obviously, the component for the humanoid robot, the Yvonne producers as well.
And are these immune to tariffs, these sort of sectors?
Well, a lot of them are now not subject to tariff at this moment. Yeah. They are not like the chips related. Those are more sensitive areas.
All right, Matty.
All
Great
right,
stuff.
Matty, thanks so much. Matty Zhao, head of Asia Pacific Basic Materials, Oil and Gas of BofA Global Research. Yvonne?
Yeah, we're watching the moves in the yen here right now. We are seeing Ueda is speaking, and some lines are crossing here when it comes to what they're thinking about rate hikes, right? Rate room is limited to boost the economy when it's needed. And also saying that it refers to the policy rate at 0.5%. So still some distance for the price trend to rise to 2%. So if they will raise the rates if the price trend becomes more certain. So it seems like they're still not sure.
They're not
whether
sure.
they can actually hike or not.
So anytime the yen tries to get some sort of appreciation momentum, policymakers kind of knock it down a little bit.
Yeah.
Now at 145 thereabouts to the U.S. dollar.
All right, we got plenty more ahead. This is Bloomberg. All right, checking some movers here. It is Pop Mart. That's what we're watching here real closely. An upgrade when it comes to the street. Yeah. And Deutsche Bank boosting that price target now to 303. Wow. That is the street high right now. They're talking about strong overseas growth momentum seen in Labubu. The stock is up some 3%. Steve, I asked you in the break. You're like, what?
What's Labubu? No, I know my daughter probably is, contributing about $100 to that stock price right now.
Yeah.
She loves Pop Mart.
Well, they're talking about this breakthrough that they're making in the West. So they think that, yes, they can see further gains from here, from Deutsche. Great call there. You take a look when it comes to Asia. Apple suppliers, what the ones in Hong Kong are doing here. So, you are actually seeing a mixed picture, but mostly actually doing quite well, right? Hon Hai's up some 1%. But yeah, there was a lack of details. There was a bit of disappointment on what they really unveiled at the developer conference when it came to those AI features. So Sunny Optical, though, still doing quite well in Hong Kong as well. There's another note interesting about casinos. So what we heard from JP Morgan. So the Macau recently closed a group of so-called satellite casinos. It should be positive overall for the industry, they say, but could actually weigh on the likes of SJM, given the uncertainty about a potential deal here. But right now you're seeing SJM shares are up some 6% here this morning. The dashboard's looking like this. It seems like we're still seeing pretty green in the board here. So yeah, CSI 300 is up about a fifth of 1%. Hang Seng is flat. Looks like we've given out some of the gains already here. And we'll watch HS Tech there now in negative territory.
Still some muted optimism as we go into day 2 of those talks at Lancaster House near Buckingham Palace in London. It wasn't bad news. It wasn't a clash, as we called it yesterday. London calling, right?
Yeah.
It was civil, 6 hours, and they agreed to talk again. And it looks like they're talking nitty-gritty as well. So that's good.
And really hitting on the things I think investors are looking out for, right? Tech restrictions, rare earths, the like here. We're going to have a lot more coming up the next hour. You're watching The China Show. Welcome back to the China Show. Here's a look at the CSI 300. And yeah, it's pretty slow going here right now. But yes, we're still near session highs. But yeah, we're talking about what? A fifth of 1%, Steve. Yeah. HSI is actually evaporating some of the gains there. H shares as well since we entered into that bull market yesterday. But yeah, it's still, we're waiting for any sort of maybe more concrete news out of London, even though we did get something at least yesterday.
We got something from the U.S. side through sources, but really nothing from Chinese state media. Definitely nothing from He Lifeng. He walked right past the gaggle of press at Lancaster House. Yep.
So we'll take a look at how markets beyond that are doing here right now. And you're watching in terms of Asia equities, still doing okay, right? So maybe the tech trade, the AI trade seems to be helping a little bit here in the face of this kind of good news that came out of London as well. You take a look at how, in particular, when it comes to yen as well, we're watching the movement there in the currency this morning, just given what we heard from Ueda, right? They're still quite hesitant to really raise rates at the moment. They're saying they're not quite seeing prices, or at least the trends, heading back to 2% for inflation. So there you go. Complete kind of turnaround for the yen here this morning, Steve.
It looks like 145 is their sweet spot right now for the yen, given the kind of hesitant recovery and the reluctance to raise rates further at the BOJ.
Yep, and obviously there's still a lot of questions about what the whole issuance side of thing is going to be around their debt buying and the like. That certainly is going to be the key focus in their meeting later on this month as well. Let's move on to the rest of Asia. Yeah, we're still doing quite well. U.S. futures, though, it's rare to see them punching this high in the Asia session. So there's still some good news around that. I mean, even overnight, there was the tech space that did quite well with NVIDIA on the good news on tech restrictions and the like, even though they stopped short of mentioning that maybe NVIDIA chips could be, in some ways, those curbs could be loosened as well. But then again, you take a look at what we're seeing here. Equity markets are basically green in Japan, in Taiwan. We're still doing very, very well. And U.S. futures as well. We're still about, U.S. stocks around 2% away from record highs being reached once again.
Yeah, that's right. And again, there's that optimism that there could be some wiggle room from negotiators in London from the United States to kind of relax some of those tech curbs and also parts for aircrafts, chemicals, and the like. So we'll have to see. There's some cautious optimism right now.
Yep.
All right, you're looking at live pictures now out of Beijing. China's State Council Information Office holding a press conference on China's improving people's well-being. NDRC, that's the National Development Reform Commission's Deputy Secretary General, is among the speakers. We understand finance ministry officials perhaps are there as well. And this, of course, Yvonne, as trade talks between the U.S. and China are ongoing.
Yeah, yesterday they mentioned about vowing to raise the minimum wage, also increase the supply of affordable housing. So that's according to Xinhua News. Maybe we'll get a little bit more meat on the bones there and what that means.
Tapping a fund that is not necessarily used to help buyers with their mortgages in China.
Yeah, sort of like another bank in some ways. Let's get more details on all things like that. Trade talks between the U.S. and China and the so-called Provident Fund. We got Rebecca Chung-Wilkins joining us with the latest here. Let's start off with U.S.-China trade talks. And at least what we heard from the U.S., things are moving along.
Yeah, certainly positive murmurs from the U.S. side. So we had 6 hours of these talks at Lancaster House, and of course the full freight from both the Chinese side and the U.S. side. And really the focus is on export controls and potentially the rolling back of more recent export controls on both the Chinese side and the U.S. side. So on the U.S. side, we had this reporting out of my Bloomberg colleagues, that the U.S. is considering rolling back some of those most recent export controls. So those include things like jet engine parts, software on how to design some of these semiconductor chips, chemicals, nuclear materials. And we had these very positive murmurs coming from Kevin Hassett, who's head of the White House National Economic Council, of course, expecting for China to be increasing the volume of those rare earths. That has been really the focus on the U.S. side, very much so.
But that's a powerful leverage, isn't it, for the Chinese, because of whether it's terbium, dysprosium, samarium.
Whoa.
These are these rare earths.
You know all the names.
Oh, gosh.
I'm not even going to try it.
I'm a geek at home at night. I'm reading up on these rare earths that we're going to be talking about. These are 3 particular rare earths that really go into the magnets. They have high heat resistance used for aerospace and defense. But that really is something the Chinese are finding as a powerful leverage to not pull back too quickly.
Yeah, absolutely. And that's really critical. But there is a sort of a time element here, right? Of course, we know China controls about 70% or more, by some estimates, of these rare earths. But they don't have a unique chokehold. Potentially, there is a way to diversify the supply chain. So there is this sort of time element to some extent. The US currently, this year, perhaps the next year, has a very urgent need for some of these. They go into some of these really important strategic technologies that you're speaking to, Steve. We have already seen some positive signs from the Ministry of Commerce, saying, for example, that they're going to increase the licenses. We have 6 months and 3 months licenses. Previously, they're just issued per shipment.
Right.
We also have them sort of speeding up the issuance of those licenses as well. So we have some sort of goodwill gestures already coming through from the China side that may be giving the US negotiators some confidence here.
All right. We'll see how day 2 goes here. Rebecca Chung-Wilkins with an update on what's going on. There are Asia economy and government reporter. Well, take a look at when it comes to what's going on in the markets, right? The rebound of Hong Kong traded Chinese stocks from the depths of the tariff turmoil is rekindling optimism once again that those gains have further to run. For more, let's bring in our Asia equities senior reporter Abhishek Vishnoi with the latest. Abhishek, this seems like there's still momentum in this rally in some ways, and you've been talking to a lot of analysts out there that say that there are still catalysts out there.
Oh, definitely, the catalysts are out there, and I was just talking to a couple of people before this conversation, and we were discussing how, everybody was looking for a creation of a new China, that will not be just the factory of the world, the role that it lost during COVID years, and how new sectors are going to lead a possible new bull market in China. And that's what probably we are seeing right now. I mean, DeepSeek was there, everything got re-rated, everything related to tech and AI. And now we are seeing a similar moment in biotechnology, pharmaceutical stocks as well. A lot of innovation happening. So, there are a few legs, specific themes which are working really nicely in Chinese markets. And that's why HSCI has just entered into a technical bull market. Now, technical bull market is actually nothing else but, taking out a previous high up 20-odd%, which actually signals a technical breakout. So there's definitely more upside. That's what chartists and analysts are talking about. And this also solidifies, what we have been looking for, that, China's role in portfolio is slowly graduating towards being an innovation hub, being a cheaper bet on technology, whether it's, AI chips or whether it's biotech, drug innovation. I mean, think about it. All this, trade tension between US and China, big pharma, a company like Pfizer is paying record amounts to a company like 3S Bio to license some of its drugs, and we are seeing similar things happening across the board. So this is definitely the creation of those couple of sectors which may possibly lead this leg of China's new bull market.
Yeah, so how broad-based is this rally, if you will, to a bull market in the 8-share index in Hong Kong? It is based on innovation. You mentioned the pharma story. I found that interesting. A lot of those pharma stocks were up sharply yesterday on the back of, optimism that AI-infused pharma would be, a gold rush, if you will, in China. But again, you have the traditional side of the economy, which is not doing well, Abhishek. Property, consumption-related, and old state SOE industries.
Absolutely. I mean, that side remains an issue. Deflation. I mean, this is all happening in the context of, China suffering, going through a deflationary shock, a deflationary phase, right? Terms like evolution, involution has been talked about. But, given all that, that is old economy. And, David, remember, there is a big divergence between economy and markets. Markets do their own thing, economy does its own thing. And markets do not actually represent economy on a very congruent basis. So markets are focusing on what will work in China, where China will be leading. So that includes EV, that includes tech, that includes biotech. And, it's the rally is not as broad-based right now because, property or the old economy stocks are yet to participate as meaningfully. But these new sectors, this new China, as everybody was looking for, that has started participating, and that will probably continue to lead given innovation is coming in. Look, AI is yet to make its inroads into biotech. All this money that is coming in Chinese companies, Chinese biotech companies, it's before AI's intervention. So imagine what can happen when AI gets into it and they start producing more innovative drugs. Just as a comparison, keep it in mind that the highest number of US FDA approved plants outside of the US are in China and India. And there were, a lot of expectations that Indian companies would also produce a lot of innovative drugs. But that has not happened over the last decade. But in case of China, that has happened over the last 3-4 years. So that's the big difference. So, this is probably going to create a lot more wealth, for a lot of investors. But yeah, it's not very broad-based rally right now, but it's very specific and very strong to the new themes tied to this new China.
Yeah, I have a feeling we're going to be using that terminology that JPM used recently, and that is the deep-seek moment for pharma. Could be in other industries as well. Asia Equities senior reporter Abhishek Vishnoi in Singapore. Thanks so much. Still ahead on the China Show, Morningstar joins us with their market outlook and to unpack their China Mind the Gap report. What's that? Plus, BNP Paribas Wealth Management shares their predictions of the top surprises for the second half of the year. Much more coming ahead. As you can see, Germaine and Grace are joining us. Much more ahead on Bloomberg. This is The China Show.
All right, we're taking a look at when it comes to Chinese markets. And as Abhishek mentioned there's still a lot of good news to kind of chase this rally that we're seeing in Hong Kong, in China as well. We're seeing gains about a third of 1%. CSI 300 is also doing decently well here this morning. And with Chinese equities really running strong, let's discuss where the investors can really find those opportunities in mutual funds. And there seems to be a gap with what investors are looking into and when they actually get into these sort of funds and products versus what the actual total return is right now.
We all know when we get on the train, mind the gap, right? That's the name of the report.
Let's bring in Germaine Sher here, Asia Director of Managing Research at Morningstar. I believe you said this is a global sort of survey you do, but the first time that you've actually really highlighted what you're seeing in the mainland and onshore investors. Can you just explain to us really what you found so far?
Thank you, Yvonne, for the question. So there's been a lot of market volatility and uncertainty, and investors could be very tempted, they get nervous, to dump their investments. So this study is basically to see how effective the investors' buy-sell timing decisions are on their funds. So with this study, we've introduced a proprietary data point called investor returns. So what are investor returns? It's basically trying to capture an investor's buy-sell decisions, which we proxy by fund inflows and outflows, to see how it impacts the returns that they're actually able to take home.
What's the biggest takeaway from this chart? It looks a little convoluted, but if we look at it, if you look at it, what should we draw from this?
So negative gaps are bad. Negative gaps means that investors are not able to fully capture the fund's returns, even if it was a good fund. So what jumps out to me here is definitely the sector equity funds that has the biggest gap which means that investors have a very poor experience when they buy these funds.
And these are more of the higher risk products that you're saying.
That's right. So these are usually equity products, and they tend to be thematic products. So if you recall, like consumer funds, healthcare funds, new energy funds, these are all focusing on a narrower investable universe, and these tend to be subject to wild performance swings. And in addition, given that they're invested in a narrow investable universe, they tend to lag over the long term compared to funds that invest in a broader investable universe.
And how much are these gaps exacerbated by the fact in China it's a highly retail-driven market, and herd mentality is the law of the land oftentimes?
That is an excellent point, not even a question, I think. So this is typical of the buy high, sell low behavior, which we see most prominent in retail investors. So they often want to get in, they want to try to make a quick buck, but often they get in too late and they suffer the downswing of the funds, and they also sell at the lows.
So what to do with this sort of advice then? I mean, first of all, how do you narrow the gaps in some ways, and how do investors that are not retail, how do they navigate around this sort of environment?
So I would say overall a healthy ecosystem is needed to improve the investor gap. This includes investor education. We need to understand that buy and hold is the best way to allow your assets to unlock their appreciation potential. We also would like for fund providers and fund distributors to be more thoughtful in terms of the products that they launch, and make sure that they are launching products that are within their core investment capability that they can deliver for investors.
Is there an information gap as well in China as far as transparency about what actually they're buying and the risks associated with that, and what kind of regulation is needed, if you will?
I think in terms of disclosure, China actually does a really good job. I think at some points better than Hong Kong funds do. So for example, in China, it's required that you disclose the portfolio manager names. But in terms of regulations, maybe to pivot a little bit, so there's been the launch of the private pension scheme in China. So for the longest time, it was a state scheme, and investors didn't really get to pick what they were buying. So now with the private scheme, what's interesting is that we see their funds launch with lockup periods. So once you get into the fund, you cannot get out until a year later, 3 years later. And going back to the study, we've actually seen that investors in those funds tend to have better investor return gaps.
Can you give some examples of just where things have just been really gone, or people have just gone in at the wrong time? I mean, you mentioned the consumption theme, where people have been very debatable whether to go in or not, given that the recovery is still very slow, the consumption side of things. What is that? What can we learn from that?
So I would say it's definitely important to pick high quality managers, and this is the bread and butter of what we do at Morningstar. So we want to pick portfolio managers, which is why portfolio manager name disclosure is so important, that are experienced, that are well supported by stable and well-resourced investment teams, as well as applying a consistent and repeatable investment process.
All right, Germaine, we're going to leave it there. Germaine Sher there, Asia Director of Managing Research at Morningstar. Just as we were speaking, we're actually taking a look at the MSCI China. So that index is now rising and really taking the gains from what we saw from those April lows to 20%. So if we continue on in this sort of momentum by the end of the trading session, that means MSCI China also has entered into a bull market. We got plenty more ahead. This is Bloomberg. All right, we got a big event coming up, Steve.
Yeah.
It's called Bloomberg Invest, and it's coming here in Hong Kong tomorrow. So we have leading investors, deal makers, economists, and money managers discussing how to really navigate all what's going on in the headlines. And
you're going to be there too, aren't you? Later?
We're bringing the China show there, man.
Yeah, I know.
On stage, live
China
conversations.
show on the road. Sounds good.
We love bringing it on the road, right? And so David's going to be there on stage. Also, alongside him is going to be our very own Shonali Basak here, our global finance correspondent, visiting us from New York. It's great to have you here in Hong Kong.
It's so good to be here. I've been looking forward to this all year long, taking the show on the road to come across the world and hang out with you guys.
Well, great. Well, just tell us about the headliners first and foremost and what to expect tomorrow.
It is such an amazing day that we have planned. We have Paul Chan really starting off the day with David, and we're really looking forward to what he has to say, not only about what's happening on the ground here in Hong Kong, all the money that's being attracted here, all the finance firms that are coming to Hong Kong, the interest that there is here, but also tariffs. I mean, at the end of the day, this is dominating the discussion from New York to Hong Kong to Japan. I don't know about you guys, but the day after this event, I'm watching the U.S. Treasury bond auction very closely. Perhaps that's one for the nerds, but at the same time, it's a good time to talk about it with all of these large foreign investors. We have the CIO of Allianz Global, for example, the Asia Pacific head of Apollo, among many, many others, to weigh in on just that.
Well, we clearly here in Asia follow what happens in the U.S. overnight. We obviously follow here in Hong Kong what the Fed does. How closely and how exponentially more are the investors in New York and the East Coast of the United States watching what's happening here as a precursor to their trading day?
One thing I'm watching the most closely is the differential between the U.S. and Japan. A large global investor just a couple of weeks ago said what they anticipate, and this is somebody managing hundreds of billions of dollars, a large global sucking sound under the market, this liquidity trap being created with a misunderstanding on how generational this carry trade has been. And you look at a recent Treasury report, for example, from the United States, this pressure to see interest rates higher in Japan. At the same time, for investors, that's a really hard dynamic to live with, isn't it? When the idea here was to borrow in a low interest rate currency to buy U.S. assets, the ramifications of that have not yet been seen and are widely misunderstood. So it'll be a huge topic in the coming days.
What about China? What's going to be discussed about China and this investment universe right now?
Well, the moment we're in right now, the relationship between the U.S. and China on the heels of the meetings that we've seen this week, the tit for tat, really the re-escalation and de-escalation that we've kept seeing. I know even back in the U.S., every time I talk to investors, when we see signs of peace between the trade disruptions, there is a sense of mistrust in that they feel that it will flare up again soon, even when they see a sense of calm that is created under the market. So is that the same here? Is there a trust in the U.S. foreign policy such that foreign investors here in Asia are willing to buy U.S. assets, going back to the dollar discussion, but also much wider?
Yeah, that's what we do every day. We headline surf and navigate the perspectives that are coming out of this part of the world. Sonali, thanks so much. Welcome to Hong Kong, and good to see you later this week at the Bloomberg conference here in Hong Kong. Here's some other corporate stories we are following. Bloomberg has learned that Barclays is preparing to cut over 200 investment banking jobs. Sources say staff in global markets and research may be impacted, with managing directors the most senior roles affected. The move is meant to give the bank more capacity to invest in priority areas such as European rates, equity derivatives, and securitized product trading. Well, Disney says it must pay Comcast almost $440 million more to complete its purchase of the Hulu streaming service. The transaction will reduce Disney's net income in the fiscal third quarter. Disney has already paid nearly $9 billion for Comcast's one-third stake in the business, valuing Hulu at around $27 billion. Comcast has argued that the business, though, is worth much more. And Warner Brothers Discovery shares gave up its 13% opening gain to close 3% lower after announcing a split of its fast-growing streaming business from its legacy media channels. The move unwinds much of the 2022 merger that combined Warner Media and Discovery. The streaming and studios business will be led by CEO David Zaslav and will hold a 20% stake in the new global networks business. And Vietnamese EV maker VinFast has reported a net loss of about $712 million in the first quarter. That's 20% bigger than a year ago, despite revenue growing by 150%. The company faces rising operation costs tied to its global expansion plans. VinFast aims to deliver over 200,000 vehicles in Vietnam this year while doubling global deliveries.
All right, we're taking a look at when it comes to movers here this morning. HSI seems to be we're teetering between gains and losses here this morning, and we're seeing some, when it comes to the Apple suppliers, it seems like actually a better picture across some of these Asia suppliers than we thought, just given that there was a bit of disappointment on the AI announcements coming through from the development conference as well. So Hanhai is actually still up some 1% as well, but the tech space certainly getting a lot of traction on some good news when it comes to U.S. and China, trade talks and the likes as well. Rare earths still continue on.
Sure, absolutely. When China controls 70% of the production of the world's rare earths and 90% of those rare earth magnets, you got a bit of a monopoly, right?
Yeah.
So those are seeing some optimism that the flows could go, the taps could be opening a little bit wider as a China concession. Depends on what the United States offers as well, and the concessions in the trade talks ongoing in London.
Yep, tech restrictions could be loosened. That certainly is what they've highlighted here so far. And you take a look at the rest of the markets. Yeah, it continues to be a up arrow story here, with the Nikkei really the one that's getting the most here, about 1%. So is the Kospi. Hang Seng, we're up about 80 points right now. But as we just mentioned, MSCI China close to entering into that bull market. Plenty more ahead. This is Bloomberg. $11:29 a.m. in Tokyo. Japanese markets are heading to that lunch break. It looks pretty dreary out there in Tokyo. I hope you guys are staying dry. But yeah, equity markets are still doing quite well. It's still pretty bright and shiny there. We're up about 1%. The Nikkei 225, $1 yen. That's where you're seeing that weakness come through here. Not sure really what the driver was, but maybe it was those Ueda comments talking about, look, they're not quite seeing that, prices heading to that 2% inflation target here sustainably there. So it seems like they're still unclear when they can actually start raising rates. They need to make sure that things are looking a bit more certain there. So we're watching very closely dollar yen at 145 here right now, and your JGB 10-year at 147.
All right, Yvonne, let's bring in now Grace Tam, Chief Investment Advisor at BNP Paribas Wealth Management, Hong Kong. I paused there because I have to print out the hard copy. I'm a hard copy guy of the Mid-Year Market Outlook 2025 from BNP Paribas Wealth Management. Welcome to you on the first front. What's your key takeaway about what we're going to be seeing into the second half of the year? Obviously, the first half of the year has been headline surfing, a lot of volatility in the markets and in the news flow. What's the second half of the year? What's the primary driver?
Yeah, actually, for the first half, despite all the volatility, all the noises, actually the equity market actually performed very well. But in the second half, I think we hope that things get clearer, especially whether we're going to see trade deals with some of the countries, and also
we've only had one so far, Despite all this noise, we've only had one trade deal between the U.S. and UK.
Yeah, that's right. But we actually think that there may be some uncertainty could last. As long as Trump's still here for the next, even for the next 3 years. But we actually think that the worst of the tariff tantrum is already passed. But of course, compared to past years, the uncertainty, especially in terms of policy, still higher than normal. But I think it looks like market is used to that. Yeah. And as long as, it doesn't really bring U.S. into recession, we think it is actually still a very good environment for risk assets, especially if there is room for Fed to cut rates. And our base case is they will start to cut in September. Yeah, and of course, in the coming months, we're still seeing the inflation data, whether is going to pick up, and I think tonight or tomorrow, we're going to have the CPI numbers. But we think that should be, any inflation induced by tariffs should be temporary. So the Fed is going to look through that and may start to cut rate. Our base case in September. Yeah.
Yeah, it's interesting because the market's still thinking maybe not even two, maybe just one cut this year from the Fed here right now. But you're still thinking it's a positive environment for equities. We're already talking about records for global stocks. Where else can you still kind of continue to chase these returns?
Yeah, I think is everything is actually turned out better than expected. I mean, because of course we have all the negative news flows on tariffs or on like the big beautiful bill. The big beautiful bill actually is a positive because it's talking about tax cut. It should be positive for growth. But I think the negative is about the rising deficit that people are concerned about. So I think net actually, I mean, for growth is actually still a positive environment. But for the bond market, I think we could see like a bit of concerns, especially in the next couple of weeks, whether, I mean, the big beautiful bill, we're going to see like rising deficit, or actually a lot of people talking about the Section 899. That's actually drive a bit of concerns.
Well, let's bring up the full screen graphic, as we call it in television jargon, of the top surprises for the big beautifuls. There's a number of big beautifuls, not just the bill that's going through Congress. Big beautiful stock market. You think the U.S. is going to hit record highs even as the trade war progresses. Big beautiful bond bloodbath. Big beautiful bond rally. Big beautiful peace deal in Ukraine and Russia. And big beautiful breakup. That already happened between Trump and Musk. So these are not surprises anymore.
That's actually that's a polling for our audience. To see whether what they choose as their top surprises. But we think for now, actually, when you look at like S&P and Nasdaq, they're just like around 2% away from the record highs. So, I mean, as we all know, for the first quarter earnings, it's actually not bad. It's actually quite decent. And especially for like the MAT 7. For MAT 7, we think we should be more selective. But actually, with some of the MAT 7, actually, earnings are really, really good. And overall, actually, the MAT 7 is beat consensus by like 13%. So this is actually, I mean, a bit of surprise, to the upside.
EU, you talk about upside there. Why do you think what's happening there? They're cutting rates, fiscal spending coming in Germany. Why do you think this time around it's a game changer?
I think especially, I mean, when we talk about Germany, it's over the past many years, decades, they're doing like a fiscal austerity, but now is like a big change, a U-turn, that they are doing fiscal stimulus or fiscal expansion. So I think you can see from the especially for the market sentiments, they are like have more confidence on the European economies, and like we've been seeing like for example like GDP growth being revised up, things like that, and also as you mentioned already, the ECB actually continue to cut interest rate, and that actually also help the economies. And we also think that, especially for Europe, we actually have been seeing the flows. Actually, after a few years of outflows, we've been seeing inflows this year. So you can see that there could be a lot of like repatriations from elsewhere back to Europe. But also when you look at the euro dollar, the euro is actually pretty strong. And like in the past, when the market risked off, for example, like in early April, people usually think like dollar, yen, or Swiss franc. They are usually the safe haven currencies. But in April this year, so actually it's the euro, the yen, and the Swiss franc. Euro seems to become the safe haven currencies.
What's your read on China and the entry points with potential dips? But as the markets are heading towards bull markets right now, on optimism that perhaps some of the headwinds from trade can be alleviated a little bit.
I think, of course, the focus this week will be on the trade talks. But the market seems to be a bit optimistic, but we're not sure. Because I'm for now, I'm thinking it's more like a range-bound trading market in the short term. But if there is any like catalyst, if like for the U.S.-China trade talks, or any catalyst from like maybe on the China tax, any good news or better than expected earnings, things like that, or even like on the stimulus funds, if China is doing more in terms of stimulus, it doesn't really need a big bang, but something that could surprise market, and that could drive the Chinese market some breakouts.
I want to get your take on the bond market, because you're saying the rebound in yields is actually a time to actually gain more bond exposure.
Yeah.
So are you expecting that, this melt up in yields maybe is a good opportunity?
Yeah, I think especially in the coming weeks, market concerns about the rising deficit, things like that, and that could be some kind of like spike in yields. But we think those are opportunities to accumulate bond exposure. Because for market, there's some talk about whether there is American version of the least trust moment. Yeah, but as you know, last time how they calmed down the UK government bond market is the BOE. They had the emergency buying. So we could still have the risk of the American version of least trust moment. But at the same time, as you know, the Fed will be the buyers of last resort. Yeah.
Grace, thanks so much for unpacking all of this for us on this Tuesday morning. Grace Tam, Chief Investment Advisor at BNP Paribas Wealth Management, Hong Kong. Well, coming up after the break, China's solar industry is facing, the bad pun, dark clouds when it comes to demand, heaping new pressure on an already stretched market. We'll shine a light. Oh boy, who's writing this stuff? We'll shine a light on the outlook next. This is Bloomberg. Okay, welcome back to the China Show. We're looking at Chinese solar stocks as manufacturers meet in Shanghai, facing fresh concerns over slowing demand in the world's largest market for panels. Let's bring in Bloomberg energy reporter Stephen Stepkinci in Singapore. What will be the main topic of discussion in Shanghai? It's a market that has really been hammered by hyper competition and falling prices.
I think the main topic will be, are we going to continue to be hammered by falling prices and intense competition? It's going to be more of the same. If you brought me on the show last year, even the year before, I would probably say the same thing. What's interesting is how this industry continues to somehow produce panels beyond what the consumption is, and then on top of that, not really consolidating. Any other view, you would see this industry cut back production. You would see much more bankruptcy. You would see more M&A. But what's interesting here is that there's been a number of different factors that have forced further competition, and also not as much consolidation, nor have they joined together in an OPEC-style view to kind of reduce their production. Instead, they're all sort of seeing, where is the bottom before they start, doing more M&A. They're also really bullish on the future of renewable energy. So no one really wants to cut back their output, right? If you're the one who's cutting back, then you could lose market share as China shifts to potentially increase the amount of renewable energy, both at home and abroad. There are also export markets that China still hopes to tap, despite the ongoing trade war and anti-dumping tariffs in the United States, as well as those being looked at in Europe. So it's a conference where people are discussing the future of the industry. Already we've had some big executives kind of put more of an upbeat tone. They're surviving. They think that the health of the industry will improve over the next few years. But again, I have to preface that by saying we've heard all of that before.
And yet, Stephen, as you highlight the challenges, people are still expecting installations are going to pick up. I think Bloomberg NEF is saying, 9% growth year on year when it comes to solar installations. So what is causing this big rush, and is it sustainable?
Right. So you had a big jump in solar installations just last month or 2 months ago. You had a really big increase because there are some policy changes that are happening in China. One of the most important ones being that they're changing the way that power is being sold from solar projects. So you saw in April this big jump for 2025. That's not necessarily because there's a huge demand for it, but because they want to get in before this May-June deadline that basically says if you're going to be selling your electricity, you have to sell it at the market price, not a higher kind of set tariff where you can make a bigger profit. Ultimately, that's good news for the industry. While it might hurt some producers, of course they want to sell their electricity at as high a level as possible. Market prices means that now there's true competition in the power sector. And renewable energy, when it's producing, it's essentially free. So, solar panels, solar energy is the most affordable in China when it is producing. It's not around the clock. But that means that they will probably be able to mark out some more market share. Now, there was that rush in April. We're not going to see that continuation probably for the next few months. I bet you're going to see a bit of a cliff. But again, as BNEF said, as you rightly pointed out, there is an expectation that there will be an increase later this year because ultimately you are seeing this drive to increase renewable energy in China. You're going to have the 5-year plan come out next year, which will kind of focus on how they're going to shift to a cleaner economy. And a lot of that is going to depend on renewables. So when we get some more hints on that later this year and early next year, you're going to have a much better view on what the solar demand will be in China over the next 5 years.
Well, Steve, how much of this problem that the industry is facing right now is a direct result of authorities, NDRC and others, essentially naming solar as one of the new three? It's EVs, batteries, and solar. And how does that state support play into the overall global trade war? We know Chinese producers have put German solar companies out of business. It's a disruptor.
It is a disruptor. And it's something that the rest of the world is struggling to grapple with. China makes the most solar panels anywhere on Earth, and they make them cheaper than anywhere on Earth, and they're also the most advanced than any other place on Earth. And what's interesting, this is one of the few bipartisan sort of issues that both Trump and Biden sort of get behind. They want to protect the U.S. industries, and the Biden administration started to push through anti-dumping tariffs on Chinese solar panels. I mean, it happened many years before that, but they're a fresh round of panels that were being produced by Chinese companies outside of China in Southeast Asia, where they had moved bases of operations after there were tariffs on Chinese panels. So strategies to get around tariffs, strategies to expand their footprint outside of China and try to take over more of the market has really been an issue for China. And companies and governments are really kind of pushing back. You've seen the European Union also look at this as well. The U.S. is clearly seeing this as an issue for their own domestic industries. So yes, the Chinese government has put a lot of support behind solar. But maybe if you take a step back and you look at this more holistically, if we're talking about the existential crisis of the energy transition and of global warming, ultimately, there are some people that are saying, hey, isn't this just a good thing? Shouldn't you be making solar panels? Shouldn't you be flooding the market with the cheapest solar panels possible? So it's unfortunate that these trade wars could actually hurt, the energy transition for certain nations.
Stephen, thanks so much for your time and unpacking that story. Bloomberg energy reporter Stephen Tachinski in Singapore. We have some headlines crossing from a finance ministry official at a briefing in Beijing. China is working on setting up a childcare subsidy system. And this, Yvonne, is all part of the government's efforts, to boost out social welfare. And as two parents in households are going to work, as costs have risen in China, they're having fewer children, but two parents are oftentimes in the workforce right now. Childcare subsidies is something that has been discussed, along with pension reform on the opposite end of the aging scale.
Yep, so certainly working on some of these structural reforms and the like here and really improving the livelihood of people. That is certainly something that we learned yesterday, too. There was a readout there talking about raising the minimum wage, for example, as well. So certainly we'll hear more from this briefing coming up once we hear more details. We got plenty more ahead. This is Bloomberg.
And welcome back. We're on the home stretch of the China show. Apple suppliers in Asia in focus after the tech giant unveiled its most sweeping software redesign yet at its annual developers conference. However, it failed to impress investors who were looking for more on the AI front. Bloomberg Technology co-anchor Ed Ludlow has more from Apple's campus in California.
The core of Apple WWDC was Liquid Glass, a new operating system interface that basically takes the UI for all of Apple's operating systems and makes the design more uniform. The UI is translucent, it's able to adapt to content and context, but it's very much based in the work that Apple has already done with Vision Pro and the OS for that platform. They're also changing how they name OS. We're going from a version-based labeling system to a year-based one, but for the preceding year. So, for example, for iPhone, iOS 26 will be the latest version. Away from that, just remember that WWDC is a developers conference, and probably one of the biggest pieces of news was that Apple will let third-party developers have access to Apple's on-device large language models. In other words, the developer community can look at Apple's technology, its existing work in AI, and use those tools to help develop apps for the Apple ecosystem. And that's the big part of WWDC. It's not just one single day. It's a time where all of the developers that have been so key in growing the ecosystem for Apple come together, and Apple can say, this is the tools that we've got, you can build on top of them. The stock did drop sharply, literally in the opening minutes of the keynote presentation. And a part of that was senior Apple executives basically saying, we have nothing to say about Siri right now. The kind of core of Apple Intelligence and Siri, the delay to some of that functionality, and we won't hear more about that later in the year. Even though expectations around what Apple would or would not say around AI were pretty low going into this, it's a stock that's been under pressure year to date, underperforming many of its Mag 7 peers. But that trading so far in 2025 has been trading on trade risk, tariff headlines, not necessarily on the AI story. The concern coming out today was, well, did we hear enough that we understand the roadmap forward when it comes to Apple and AI? For example, in some of the tweaks and iterations they announced, we saw a deeper integration with OpenAI and ChatGPT than we did Apple's own original work in AI. Even so, the thing about Liquid Glass and a new operating system interface is that it kind of hints at Apple's next era for design, a software foundation. But read between the lines, take the name Liquid Glass, and you might learn a little bit about what's coming next for Apple's hardware as well. Ed Ludlow for Bloomberg News in Cupertino, California.
All right, before we go, we're going to take a look at these markets here, and one stock that continues to really defy expectations and continue to kind of edge higher is PopMart. That price target hiked once again by the likes of Deutsche Bank here to a street high, right? So we're talking 303 Hong Kong dollars. And they're really talking about this breakthrough that they're having in the West when it comes to Labubus here right now. So they're saying, yeah, it's just the beginning of them really getting into this market here. So, yeah, you got to ask your daughter what Labubus are, Steve.
She knows.
She knows?
She knows. Yeah, it's popping higher for sure.
So, overwhelming surge in demand is what they're saying around Labubu.
There's no more floor space in my daughter's bedroom.
Really?
It's just filled with stuff.
Okay. Maybe well, Labubus are quite small, and you hang them on your purse or your backpack.
Okay, she's got many of those too.
All right, you take a look at when it comes to MSCI China. That's the next thing to watch here. So the next in terms of some of these benchmarks in China to enter into that bull market if we continue and end the day in this way. So we continue to watch that space as well. We already saw the HSCEI yesterday enter into that bull market territory. Yeah. S&P as well, right? We talk about we are off the 20% lows there from April, just 2% away from that record high. Hang Seng is doing, relatively speaking, okay. You take a look at how the rest of the region is doing, though. It continues to be a good news story, right? Because you have AI tailwinds, you have U.S.-China talk hopes that are continuing on. So you look at your GMM function, it really is some of these tech-heavy benchmarks like Taiwan is seeing gains of more than 2% here right now. The Kospi, Nikkei are also doing quite well. So it is still the whole chip story, rare earths, those things are still driving these markets.
Expectations that the United States has room to relax some of those technology curbs that they imposed after that Geneva truce, and that China can reciprocate with more export licenses and faster export license approvals for rare earths.
Yeah, so everything from chip design software, chemicals, those are some of the concessions here, but not quite where you're getting to when it comes to those most sophisticated chips that are made by NVIDIA there. But still, a little bit more meat in the bones there. That's it for us here on the China Show as we count down to those trade talks in London.